Hey guys, it's Mark. Thanks again for tuning into our Instagram TV channel. We really appreciate it. Thank you to all of our followers. We like to do these videos because we get questions all the time throughout the country, relocation buyers, new home buyers, luxury home buyers. So today I want to go over a couple examples. I want to put you onto a website called mortgagecalculator.org. It's a great resource tool that we refer a lot of our clients to. It's a great tool to play around with numbers as you kind of prepare to speak with the lender to give you a realistic expectation of what your monthly payment might be and closing costs and down payment and all things like that. So mortgagecalculator.com. So we talked about in the last video $175,000 and $200,000 price point for the first time home buyers. Now we're looking at the next home buyer that might be relocating, that's maybe not bought a home before, but has been saving for quite a while, maybe accumulated a lot in their 401k or a substantial amount, in either a first-time home buyer or they're that second or third home buyer that has worked their way up from that $150,000 to $200,000 range. Situation where a person's single and just wants a good amount of space or a good location close to the city, or a family situation has changed. You bought your first house as a single person and now your family has expanded and you need more room and you have now a couple incomes coming in. So let's give you some examples of what it would be like at a $300,000 price point. So at $300,000, if you can really get that score in the 700s, you're going to be able to qualify for a conventional mortgage, which only requires 3% down. And the good thing about it is once you reach that 20% equity in the home, after multiple years, once you get that 20%, your PMI, private mortgage insurance, automatically drops off, which it doesn't on FHA. So I always tell people, really, in this point in your life, if you're looking in that 300, 350 price point, you really should have a very, very strong credit score. I'd say in the really high sixes, but preferably in the 700s, definitely. And this would be an example for somebody going for a $300,000 house with a conventional 3% mortgage. So 3% of $300,000 is $9,000. Then you have 4%, which is a calculation that we like to use for closing costs. That's your escrows for your property taxes, homeowners insurance, money that they collect up front to help establish an escrow account to pay when your property taxes and your homeowners insurance come due each year. Then you have your attorney fees and your mortgage origination fees, because the mortgage lender and broker need to get paid as well for processing your loan. So combined for a $300,000 house, you're looking at $9,000 plus $12,000, so that's $21,000. So if you wanted to buy a home cash, cash to close would be about $21,000. Now, where we would come in as your agents is a lot of times agents such as ourselves can negotiate, or if you're going to a new home community and you use one of their preferred lenders, sometimes they will offer you a contribution towards your closing costs. And we've seen sometimes where they'll pay all your closing costs. There's a builder that just sent us some incentives for any of their standing inventory for new homes that they'll pay all your closing costs. So in that situation, that would really save you $12,000. But say we can negotiate and the builder or the seller is willing to pay half of your closing costs. So your closing costs, instead of be $12,000, maybe be $6,000. And it might be easier to come up with $15,000 as opposed to $21,000, right? Or it might be easier if they pay all your closing costs to only have to come up with $9,000 for a $300,000 house. So keep that in mind. But worst case scenario, $21,000. So at that, we assumed about a 5% interest rate. It might be a little bit lower, but that's about what the rates are right now in this economy. We assumed about 1.2% for your property taxes and homeowners insurance around $1,700. So property taxes at $3,600, homeowners insurance at $1,700. Your monthly payment would be around $2,125, which is really good. You could get a lot of house in a really good area close to the city for $300,000, or you could get a really, really nice size house on the outskirts. Both resale and new home. So $2,125, that can get you definitely a 4, 5, 6 bedroom house. And just to show you an example, you know, if you held on to the house for 5 years, and how this is so much different than renting, by you're contributing every month to the principal, as well as your interest and your property taxes and escrow that make up your payment. But every time you're making a payment, say 5 years later, your balance on that $300,000 house would be about $267,200. Now, assuming real estate, you know, your home appreciates 2% a year. So for 10 years, that's 10%. Your home could potentially be worth $330,000. So you're sitting at that point, 5 years into it, $62,800 worth of equity. If you were renting, you have nothing to show for it. So this, again, conservative potential. It's not viable or adverse. It's just an example, $62,800. And then say at the end of the 5 years, you wanted to move up into your $400,000 or $500,000 house or your dream home, whatever the situation may be. You could either hold on to it and it's an asset and you could, you know, rent it out. But if you sold it and paid a traditional 6% commission to sell it, you're still walking away with $43,000. Again, that's pretty darn good. And plus all the tax write-offs that, because you pay a lot of your interest up front in the first 7 to 10 years of your mortgage. So in addition to all the tax breaks, $43,000 in profit is not bad. Now let's look at a $350,000 house, because this would still be eligible if you had to go FHA, but again, always the goal of going conventional and getting that 3% down program. Now, if you are relocating and you just have more of a lump sum to put down, you could calculate off of 10%, off of 15%, and the key number being 20%, because then you'll avoid what's called private mortgage insurance. And it's automatic equity that you have in a house by putting 20% down. But for most people, again, they're going to be looking to put the least amount of money down. So at $350,000, 3% conventional, again, a really good credit score, over in the 700s, you're looking at $10,500 down, 4% for your closing costs, that's $14,000. So all in is about $24,500. Now again, new home community, are negotiating on an existing or resale home, asking the seller to help pay for some of that. It could be less than that $24,500, but that's just an area, you know, to give you. Again, assuming a 5% interest rate, you might be able to buy it down for a lower rate, or depending on when you're buying, the rates might be higher or lower, but we're going off of 5%, which seems to be the rate right now. Property taxes, again, 1.2%, $4,200. Your homeowner's insurance around $2,000. So your monthly payment should be around $2,481, so around $2,500 a month. So again, $350,000. That's a really good price point. We've gotten a ton of our clients in that $300,000 to $350,000 range, and you can get amazing houses in Henry County, Fulton County, Douglas County, Cherokee County, DeKalb, Gwinnett, all the major outskirts of Atlanta. And you might, you know, if you want to get a 1-bedroom or 2-bedroom in-town condo or townhouse inside the perimeter, you might be able to find that as well, or some kind of up-and-coming areas like the West End. So good price point, $350,000, good payment around $2,500. Again, let's look at 5 years later. You're looking at your principal going down to $312,000, estimating a 2% value increase every year. Your house could potentially be $385,000 at that point. So you're sitting on $73,000 worth of equity. So again, guys, you know, if you decide to keep it and rent it, you know, you could rent it out for more than your mortgage payment. You could sell it after commissions. You're still gonna probably walk away with $50,000. That's enough money to potentially, you know, invest in, you know, your next house, invest in your stocks, your bonds, investing in starting up a company if you want to be an entrepreneur. So these are just 2 more examples at these price points of what your payments are looking like. So again, around $300,000, around $2,125, and at $350,000, around $2,500. And you can see all the potential equity. And that's just if you sell after 5 years. But if you hold on to it longer, more and more equity you're building. So I hope you guys enjoyed this video. I'm going to keep doing some more. I'm all about the education. Even more importantly though, guys, give me a call. I'll put you in touch with the lender. We'll have a conversation and we'll get your home buying process started. Okay, we'll talk to you soon.